November 1910. 7 men boarded a private train in Hoboken, New Jersey. Each man represented immense financial power. They were told to travel alone, leave their last names behind, and speak only their first names. No assistants, no secretaries, no press. Their destination was a secluded island off the coast of Georgia, known as Jekyll Island, home to an exclusive club whose members were America's wealthiest families. The purpose of this secret journey was simple, terrifying, and historic: to design a system that would stabilize the American economy while giving control of the money supply to a select group of financiers. In other words, they were about to write the blueprint for America's first central bank in over 70 years. To understand why this meeting was necessary, one must go back to October 1907, when the United States experienced one of its first modern financial panics. The stock market collapsed, banks failed, and depositors rushed to withdraw their money. Panic spread from New York to San Francisco. Without a central bank, there was no lender of last resort. The system was on the verge of total collapse. It was in this chaos that J.P. Morgan, the most powerful banker of the era, acted. He summoned the major financiers of New York and locked them in his library. There, he forced them to pool resources to stabilize the financial system. Through sheer concentration of wealth and authority, Morgan stopped the bank runs, prevented a total collapse, and rescued the American economy. But his intervention exposed a frightening reality. The country had no institution capable of controlling its money supply. If left unchecked, future crises could devastate the nation. The Panic of 1907 demonstrated that America needed a central bank. But not just any central bank, one that could manage credit, stabilize the currency, and prevent panic in the future. Morgan, Warburg, and other influential bankers saw an opportunity to shape this institution to their advantage, blending public need with private oversight. In 1908, Congress passed the Aldrich-Vreeland Act, which created the National Monetary Commission to study the banking systems of Europe and propose reforms. Senator Nelson Aldrich, a powerful Republican from Rhode Island and a trusted ally of Morgan, chaired the commission. Aldrich was deeply entrenched in finance and politics. His daughter was married to John D. Rockefeller, Jr., connecting him directly to America's most influential business family. By 1910, the commission had gathered enough insight to propose a solution: a central banking system. But they faced a major obstacle. The public hated the idea of giving any more power to big banks. The word central bank carried memories of Andrew Jackson's battle against the Second Bank of the United States. Americans feared that a private group could manipulate money and crush the common citizen. If the public discovered that bankers were drafting legislation, the plan would die instantly. This is where Jekyll Island comes in. The island, a private retreat for wealthy elites, provided perfect secrecy. 7 men arrived representing the most powerful financial institutions of the time. Nelson Aldrich, the political mastermind. Paul Warburg, a European-trained banker and expert on central banking. Frank Vanderlip, president of National City Bank. Henry Davison, senior partner at J.P. Morgan. Benjamin Strong, future governor of the New York Federal Reserve. Charles Norton, president of First National Bank of New York. A.P. Andrews, assistant secretary of the Treasury. For 10 days, these men worked behind closed doors. They had no distractions, no outside observers. Their goal was to draft legislation that could be presented as a public reform while embedding protections for the banks themselves. The plan they devised would accomplish several objectives: appeal to public trust. They avoided the term central bank. Instead, the system would be called the Federal Reserve, a name designed to sound government-backed and stable. Decentralized perception, centralized control. Multiple regional banks would give the illusion of distributed power, but the New York Fed would dominate the system. Blend public and private influence. The banks would be the primary owners of the regional reserve banks, but there would be a board of governors in Washington to provide a veneer of public oversight. Paul Warburg, with his deep knowledge of European banking, was the intellectual architect. He understood how central banks in Germany, England, and France managed money creation, interest rates, and economic stabilization. Benjamin Strong represented the interests of J.P. Morgan, ensuring that New York's banking power would remain paramount. Frank Vanderlip and Charles Norton carried the Rockefeller influence, while Aldrich guided the legislation through political strategy. The secrecy of the meeting was crucial. If the public knew that Wall Street had crafted the plan in isolation, it would have faced immediate rejection. In fact, decades later, Vanderlip admitted in his memoirs that the trip to Jekyll Island was the occasion of the actual conception of what would become the Federal Reserve. When the meeting ended, the bankers had a draft plan. The next challenge was passing it through Congress. This would take 3 years of careful political maneuvering, including rebranding the proposal, aligning it with public and political interests, and timing the vote for when Congress would be least resistant. The seeds planted on Jekyll Island would grow into a system that shaped American economic policy for generations. But the men who met there understood that the public could not see their hand in creating it. They left the island quietly, their secret intact, carrying a blueprint that would transform the nation's financial landscape forever. By the time the Federal Reserve Act was passed, on December 23, 1913, much of Congress had already left for Christmas. The act passed with minimal scrutiny, establishing a system that balanced the appearance of public oversight with the influence of private banks. The New York Fed emerged as the dominant regional bank, and Benjamin Strong became its first governor. The foundation of modern American monetary policy had been quietly laid in secrecy on Jekyll Island. This meeting marked a turning point. For the first time in decades, the United States had a central bank. It was designed to prevent panics, stabilize the economy, and manage credit, but it was also deeply shaped by the bankers who drafted it. The story of Jekyll Island reveals the delicate balance between public need and private influence, secrecy and transparency, fear and power. And it all began with a private train, 7 men, and 10 days on a remote island off the Georgia coast. When Congress returned from their holiday break in December 1913, the Federal Reserve Act was ready. Most lawmakers had little time to read the 1,000-page bill. Exhausted and eager to leave for Christmas, they voted. The House approved it 298-60 and the Senate 43-2. President Woodrow Wilson signed it the same day, December 23, 1913. In just 3 years, a private group's vision had become law. The Federal Reserve was born, not as a single bank, but as a system, a network of 12 regional reserve banks, overseen by a central board of governors in Washington, D.C. On paper, it appeared to balance public oversight with private banking input. In practice, it created a structure where private banks had significant influence over the nation's money supply. The design was deliberate, crafted to prevent panic while maintaining financial stability for the largest institutions. By November 16, 1914, the Federal Reserve officially opened. Benjamin Strong, one of the men from Jekyll Island, became the first governor of the New York Federal Reserve, the most influential regional bank. Strong understood money like few others. He knew how to manage credit, interest rates, and liquidity to stabilize the economy while maintaining confidence in the banking system. Almost immediately, the world tested this new system. 3 months later, World War I erupted. The United States initially stayed neutral, but the war demanded enormous resources, including money. The Federal Reserve provided a mechanism to fund wartime spending. It could create new money to purchase government bonds, inject liquidity into the banking system, and support war efforts without raising taxes immediately. This was the Fed's first demonstration of its power. It could expand the money supply in extraordinary circumstances. It also showed how central banking intertwined public need with private influence. Banks purchased the government bonds, earned interest, and played a direct role in funding national priorities. This pattern, money creation for national emergencies, profit for financial institutions, would repeat throughout history. After the war, the United States experienced rapid economic expansion, the so-called Roaring Twenties. Credit was easy, interest rates remained low, and Americans borrowed heavily to invest in the stock market. Benjamin Strong, still at the New York Fed, deliberately kept rates low to encourage growth. On the surface, the economy boomed. Behind the scenes, speculation and risk were growing. By 1929, the bubble burst. The stock market crashed, banks failed, and unemployment soared. The Great Depression followed, devastating millions. The Federal Reserve had been created to prevent financial panic and stabilize the economy. Yet, its response was slow and cautious. Critics argue that tighter monetary policies early on might have mitigated the collapse, but the Fed did not act decisively to expand the money supply. Despite widespread hardship, the institutions that had guided the Fed through Jekyll Island survived. They weathered the crash and, in some cases, consolidated their power as smaller banks failed. This period illustrated a crucial point. The Federal Reserve could stabilize the financial system, but its actions often benefited banks and investors more directly than the general public. The pattern repeated through history. During World War II, the Fed once again created money to finance government spending. Debt skyrocketed from roughly $40 billion before the war to $260 billion by the end of 1945. Once more, banks purchased government bonds, earning interest as the public bore the cost through taxes and inflation. In 1971, President Richard Nixon severed the last connection between the U.S. dollar and gold. The dollar became pure fiat currency, no longer backed by physical reserves. This gave the Federal Reserve unprecedented power. It could now expand or contract the money supply almost without limit. The consequences were profound. Inflation became a regular feature of the economy, interest rates could be manipulated to guide growth, and the Fed became the primary instrument of national monetary policy. Fast forward to 2008, when the global financial system nearly collapsed due to reckless lending and mortgage defaults. The Federal Reserve acted decisively, creating trillions in liquidity to stabilize banks and markets. The Fed purchased government and private assets, effectively preventing a total financial collapse. While the largest banks survived, ordinary Americans faced job losses, home foreclosures, and economic uncertainty. The event highlighted the Fed's dual role, stabilizing the system while protecting major financial institutions. A dozen years later, in 2020, the COVID-19 pandemic triggered another economic shock. The Fed responded by creating nearly $4 trillion in 6 months, supporting banks, corporations, and government debt. Stock markets soared, billionaires' wealth expanded, and everyday Americans struggled with unemployment and uncertainty. The system consistently shows the same pattern. Money is created at the top, benefits the financial system, and flows gradually to the broader economy, often after value has been diluted. Over the century since Jekyll Island, the U.S. dollar has lost roughly 98% of its purchasing power. What cost $1 in 1913 costs over $30 today. Inflation, monetary expansion, and interest payments have reshaped the financial landscape. Every generation has seen the Fed influence the cost of borrowing, the value of savings, and the health of the economy. The mechanics are straightforward but powerful. The government issues bonds to finance spending. The Fed buys these bonds, creating new money. Government spends the money, injecting it into the economy. Taxes fund interest payments on these bonds. Banks and the financial system benefit from interest and liquidity, often before the public experiences the new money's effects. This cycle repeats with every crisis, every war, every major economic shift. The Federal Reserve System, born in secret on Jekyll Island, continues to shape economic reality in ways ordinary Americans rarely see. Despite its power, the Fed remains somewhat opaque. Its regional banks are technically private corporations, its policy decisions are often behind closed doors, and audits have been limited. While laws now exist for transparency, the complexity of the system makes it difficult for ordinary citizens to understand how decisions are made and who benefits most. What started as a secret meeting on a quiet Georgia island has evolved into the backbone of American economic policy. The decisions made in that room, guided by 7 men with unparalleled knowledge and influence, continue to echo in every bank transaction, paycheck, and government bond. The Federal Reserve is not just an institution. It is a force that shapes wealth, controls liquidity, and stabilizes or destabilizes markets. From world wars to depressions, from financial crises to pandemics, its fingerprints are everywhere. Understanding it is not merely an academic exercise. It is understanding the framework that governs the money you earn, the interest you pay, and the future of the economy you live in. Jekyll Island may have been a secret, but its legacy is undeniable. The decisions of those 10 days in November 1910 laid the foundation for over a century of financial policy, power, and influence. The Federal Reserve is the living testament to the vision of 7 men who met in secrecy to tackle a crisis, and in doing so, created a system that would forever shape the nation.